The main difference is that Visa and Mastercard is a payment processing network that partners with banks to issue cards, while American Express is both a payment network and a card issuer, meaning it issues its own cards and provides its own credit. This leads to key differences in acceptance, benefits, and how cards are issued and managed. Amex cards may offer premium perks but can have higher fees, whereas Visa cards are generally more widely accepted globally and often feature lower fees. American Express came out with quarterly revenue of $18.4 billion, up 11%. Card member spend growth accelerated to 8%, and our credit metrics remained best in class. Initial demand for the revamped Platinum card exceeded the firm's predictions, increased to $895 a year from $695, benefit from a premium customer base. With millennials and Gen Z now accounting for 36% of total spends. Expenses were $13.3 billion, up 10%. Ongoing efforts to increase coverage, especially in Europe. Largest share of marketing spend is on welcome incentives, with a focus on premium products. Provisions for credit losses decreased 5% to $1.3 billion. Primarily due to a lower reserve build compared to the prior year, partially offset by higher net write-offs. Net write-off and delinquency rates remained stable and best in class, supported by our premium global customer base. American Express's return on equity is approximately 33.5% as of late 2025. This high ROE indicates the company is generating substantial profits from its shareholder equity and is considered to be performing well relative to industry peers. Let's have a quicker look at the cash flow statement. We can see that American Express used its cash mostly in repaying loans instead of buying back stocks, given the fact that the stock price is standing at $360 per share. Moving on to Visa, it reported fiscal fourth quarter result. Revenue was $10.7 billion, an increase of 12%. As of a recent period, Visa's ROE is approximately 52.7%, meaning it generates about 53 cents in profit for every dollar of shareholder equity. This high ratio indicates that Visa's management is effectively utilizing shareholder capital to generate earnings. Visa doesn't report an efficiency ratio because it's a payments technology company, not a bank, and its business model is different from financial institutions that commonly use this metric. The efficiency ratio is primarily used in banking to measure a bank's cost-to-income ratio, which is less relevant for a company like Visa that doesn't have physical branches. A traditional loan portfolio, or high-cost deposit-taking operations. Visa holds a market share of 37% of all credit cards in circulation globally. It accounts for 52.20% of credit card purchase volume, a higher percentage than its share of cards in circulation. In 2025, Visa's network volume is represented by its total transaction value, which reached approximately $14.5 trillion for the year. Take a closer look to the cash flow statement. Visa's using mostly of its net cash by operating activities in buying back its shares instead of paying its debts. Lastly, Mastercard also reported its earnings result. Revenue was $8.6 billion, up 17%. Mastercard's processed transactions increased by 9.9% through the first half of 2025. Mastercard's gross dollar volume reached $9.2 trillion. Mastercard's ROE Return on equity ratio in 2015 was 63.17%. This figure represents the company's net income as a percentage of its shareholders' equity for that year. Similar to Visa, Mastercard's using most of its cash from operating activity in buying back its stock, while these stocks' P/E, price to earnings, ratio is approximately 33.2x as of early November 2025. Successful investors like Warren Buffett have spoken favorably about buybacks when executed at prices below intrinsic value, emphasizing that they can be an intelligent use of capital when alternative investments offer lower returns. However, buybacks have also faced scrutiny for their potential to artificially inflate stock prices and reward executives who are compensated based on EPS growth. The debate intensifies when companies borrow money to finance these operations, which can strain balance sheets in times of economic distress, and depletes the cash reserves without any clawback option.